Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, we're mixing things up a little bit for this podcast.
Andrew, this one's pretty exciting. It's only taken us 55 episodes to do this, and we've been talking about it for such a long time, but we're on camera.
You can see.
Hey, so that's not going to help our listeners on the podcast, but we are also going to broadcast this on YouTube as well too. So you'll be able to.
Anyone that wants to see our faces, then jump onto the YouTube channel and you can see this as well as hear it. Doesn't have to just be via audio.
Put a face to the name, and for the first time ever, we're not in our boardroom that we keep joking about.
Exactly
so
right.
We thought we needed to come up with something a little bit more creative if we were doing it on video. And we've moved to a different location in the office. So here we are.
And Bills, we've spoken up the video, but if there is no video to follow, I just want to put a disclaimer out there. We've obviously failed at recording the video and it's only a podcast, but we will continue and we will endeavor to make sure that there is a video, if not for this one, but for future ones. But I'm optimistic. We're definitely going to have video for this one as well.
And we're that bad that the editing team just cannot fix it, right? So here we go. Andrew, what are we talking to our listeners and our viewers about today?
Well, I almost lost my footing a bit there. I thought that we were actually talking about finance and doing a podcast. I felt like we were just having a chat. We lost track a little bit. But yeah, today we're giving a bit of a market update. So talking about, what's been happening in the market, where things are at from an investment perspective, what's been happening both in the domestic Australian market as well as the international market. There's been some pretty substantial movements over the course of really the last 6 months. Has been, fairly up and down. And so we figured that there was no better time to start talking about, a bit of a market update and provide some commentary and some insights around that.
Yeah, it feels like the first time in a while that there's just so many things happening right across the different areas. And I guess for a long period of time, and a large thing that we keep talking about is the interest rate lever, because a lot of people do have mortgages, and that's the thing that really takes up a large portion of their cash flow. And the increase in interest rates from record lows, being at almost 0%, to where we are now and to where we're going, it's a substantial shift. And that's sort of one big thing that's prevalent all of the time. But not only just the interest rates, we're talking about inflation, we're talking about supply chain issues. Still return to the office is one of those things as well. So there is so many things and so many concerns around that's just continuing to create uncertainty. And tying it back into the investment markets, we are going to talk a little bit about property as well too, but just the impact that it's having with the way that the market's going, and investment markets with the level of volatility that we're experiencing as well.
Yeah. So I guess kind of the first place to start, which only seems pretty natural, is inflation. It seems to be the thing that everyone's talking about. It seems to be the thing that I don't think I've ever heard the layperson speak about inflation more than right now. But kick us off, Bills. What's happening with inflation? We obviously, assuming that everyone knows what inflation is, we've spoken about it a few times on the podcast as well. So give us a bit of a rundown as to where things are at from that perspective.
Yeah, we're all inflation experts at the moment. So I just to digress a little bit, I went to an economic update last week with one of the major banks, and I was talking to someone and saying being an economist has never been as exciting as what it has been now, because you're kind of like the rock star of the finance industry. Everybody wants your opinion on what's happening, right? But for a long period of time, it was just one of those boring things. Yeah, economic updates, away we go. But look,
I thought that story was going to take another direction. I'm going to derail us completely here. But Billy had a bit of a fanboy moment on another fellow podcaster, and he couldn't stop talking about it in the office. I think he mentioned it to me at least 3 or 4 times. He met one of his idols on another podcast. Do you want to tell us a bit about that one?
Not really, but all I will say, and we won't name drop, all right? Because I don't need to big note myself. But during COVID, when it first hit, and this is no longer a finance podcast, right? It's just us talking. But no, during COVID, not being able to, especially in Melbourne, not being able to leave the house, and you could only exercise in a certain distance from your home. So I started, walking a fair bit within our local park, and to keep myself occupied, I was listening to a particular podcast, which led to the inspiration for us to do this, by the way. And one of the ones that I had listened to that got me interested in the podcast movement, and I still listen to today, I had a chance to meet him at that economic update. So I was pretty excited about that. So hopefully he's listening, and he knows that I'm talking about him anyway. So there you go. What were we talking about?
Right back on track.
Inflation. But look, essentially inflation is it's the cost of things getting more expensive for a whole range of different reasons. But basically, the way that it's measured in Australia in particular is it's a basket of goods and services that are all weighted, and it measures how more expensive those things have become, or less expensive they've become over a period of time. So one of those things in that basket of goods is groceries. One of those things in that basket is education, transport, so on and so forth. So the idea is we measure that because the optimal range for an economy to perform, or at least for the Australian economy, and this is what the Reserve Bank set their inflation target, so our listeners and our viewers may have heard that, between 2 and 3% is the optimal range for inflation to increase and for an economy to continue to grow at the optimal pace. What we're experiencing at the moment, for a range of different reasons, increasing input costs, increasing labour costs, supply chain issues, inflation and the cost of things are rising faster and faster and faster. And as a business or as a household, how do you respond to inflation? As a household, it's difficult because you can't increase your income to match with the rising cost of inflation.
You can't do it easily.
Can't do it easily, and I guess that's a generalisation, but you can't do it easily. But as a business, taking that cup of coffee that Andrew bought this morning, 2 weeks ago it cost $4, tomorrow it costs $4.20. The business starts feeling the squeeze. They want to maintain their margins. So what do they end up doing? They end up taking that $4.20 cup of coffee because the lid or the cups have gotten more expensive, and they now turn around and it says it's $4.80. And what the Reserve Bank in particular are really concerned about is if you don't hit inflation on the head quickly using the interest rate lever, then inflation can become a self-fulfilling prophecy, and businesses increase their pricing to keep their margins. And then people are expecting, to pay more for things. And before you know it, that cup of coffee becomes standard practice that we're paying $7. So from that perspective, we need as a country, and look, it's not just an issue that's impacting Australia, but it's one of those things that you need to jump on this very, very quickly, which helps explain some of the movements that we're seeing with the Reserve Bank around the record rate interest rate rises that we've seen of late.
Yeah, exactly. And to put it into a bit of context, the Reserve Bank, or the RBA, is expecting inflation to peak at around 7.75% for the year of 2022, which you consider they're expecting, or they're targeting a 2 to 3% inflation rate per annum. So to hit a 7.75%, we're talking about almost 3 times on the lower end, but you're talking about almost 3 times the inflation of what you'd normally expect. So really, that's what's impacting to a very large degree the interest rate rises that we're seeing. And that's why the RBA is really pushing forward with interest rate rises, so that they can put a stop, or at least a slowdown on inflationary pressure, and really start to drive that down towards that target of 2 to 3%. And from all of the rhetoric, reading the minutes of the RBA meeting and reading the commentary afterwards, they're going to continue with this. They're really pushing towards increasing interest rates. They're really pushing towards curbing inflation, and there's no sign that they're going to slow this down. And it's expected that they're probably going to continue increasing rates at least until the end of the year, and possibly even beyond. And they pretty much explicitly say that. In the most recent minutes that they've literally said that they're expecting that there is going to be further interest rate increases. So for all the mortgage holders out there, really keeping a really close eye on your budget, your cash flow, and how much money is going out is going to kind of be key. Because while increasing interest rates should theoretically slow down inflation, which should mean that you're spending more money on your mortgage but less money on all of your other expenditure, it does have a lagging effect, and so there is going to be a period of hurt until essentially inflation starts to come down.
Yeah, and that's the thing around the timing with some of the interest rate rises. I mean, yes, we see it come through from the Reserve Bank. We see the majors go out because they get the TV time and the media coverage time. But we've incurred a interest rate increase this week because it's the first Tuesday of every month except for January. But we haven't even seen the impact of the previous one because it hasn't worked its way through yet. Yeah. So there is a bit of a lag effect. And from the RBA's perspective in particular, and this is a really difficult job, trying to get this balance right, and they call it a narrow path, but trying to get this balance right between making sure inflation's under control and not tanking the economy and pushing us into a recession is really difficult. So we may find that the interest rates, as the data starts to come through and gets better, and our time frame and our record keeping around inflation is improving now, we're going to, as at October, we're getting that data in every month as opposed to every quarter. So it may mean that the data that's coming through that's more accurate gives the RBA better tools to be able to say, okay, we did 50 basis points last time. Maybe we only need to go 25. And I don't know if I'm being optimistic around that.
I don't know if you're being overly optimistic, but maybe.
But just using that as an example, because the data is getting better. But my point is that they're trying to get this balancing act right, and they call it a soft landing. So the analogy that they use is try to fly a plane, and rather than crash the plane, they're trying to navigate all of the circumstances that they've got, and we'll see where that ends up. But yes, definitely agree. All of the rhetoric is pointing towards further interest rate increases, which is what we're expecting in our business, and when we're having those conversations with clients as well too. It's just one of those things that is going to continue to happen. And, we're not expecting to see any alleviation of the interest rate increases. The size may change, but we're not seeing anything, in the immediate future where interest rate increases are not going to happen between now and the end of the year. They may skip December depending on how hard they go over the next couple of months, just to try and give people a bit of a break over that Christmas period. But once again, I think it's just going to depend on what the data says.
Yeah, exactly. And I think one of the saving graces really for the economy and where things are at, which is also impacting inflation to some degree as well, is the unemployment rate, where I think it's 50-year low in terms of unemployment rate. So what we're starting to see is an actual wage growth, which was one of the concerns that was in the economy sort of before all of this inflationary pressure and the COVID environment and all of that stuff kicked in. We weren't seeing any real wage growth, whereas we're now starting to see that flow through the economy. Unemployment is still low, so that's really one of the saving graces in terms of the market and the everyday household at the moment as well.
One of the big things, at least in Melbourne, and I think it's becoming a bigger and bigger national sport across the country, is property prices. Yeah. We all love a good property story, and we're all fascinated by it. Andrew, let's talk a little bit about what's going on with the property market. In particular, and I guess for us, it's probably a bit of a greater slant towards Melbourne, but what are we seeing in the property market happening, and what are we anticipating, and how does all of this sort of play in with each other and together?
Look, from a property perspective, we are seeing a lot more uncertainty around property, around purchasing property. Properties that are being listed are being on the market for longer than what they were towards the start of the year. So it's taking longer to sell a property. On the other side of things, there's also a very much an undersupply of property. So number of properties being listed for sale is actually significantly lower than what it was this time last year, which really is kind of holding the property market up, just purely supply and demand economics. But once we start to delve into the numbers, I mean, if you listen to the media, if you listen to news articles around what's happening with property, you expect that there's been this massive crash and it's going to continue falling and all of that stuff. But I mean, we'll talk a little bit about in Australia as well. But in terms of Melbourne property prices, they're down 1.3% over the last 12 months. 1.3%. I just want that to sink in a little bit, because you listen to what the rhetoric is in the media, and you'd expect that there's been a 20% decline in property prices and everything's crashing, but that just isn't the case. Which a lot of the times when we start to talk about investment markets, when we start to talk about investment strategies, a lot of the times what we're guiding clients through is not just the investment aspect of it, but also the psychology of it, which is just turn down the noise. Because yes, we haven't seen the full impact of interest rate rises move into the property market per se, and further interest rate rises is also going to put some pressure on it. But a 1.3% down is a very, very small amount, especially when you consider the growth that's happened in the period before that. But then when you look at property prices in Australia as a whole, we're actually 3.1% up over the last 12 months. So yes, there's definitely some concerns around property prices, and I'm not going to sit here and say that whether you should or shouldn't invest. It ultimately depends on your circumstances. But at the end of the day, it's not quite as dramatic as what most people are led to believe.
I mean, look, it makes for a good story.
Yeah, it does, and that's all it is. I mean, they're selling stories, and that's that's perfectly fine. That's their business. But I guess for us, it's all about sifting through that noise and really starting to dwell down on it. I think that really the supply of properties is one of the things that's kind of impacting the market quite massively as well. So most people know that there's some concern around property, and so we're seeing people not list properties for sale that otherwise would have. So if further interest rate increases put pressure on mortgage holders, and people feel the need to have to sell properties, and the supply of properties up for sale starts to dramatically increase, then we may see something a little bit more dramatic, but that hasn't flowed through the market just yet. But we're yet to know exactly where it's going to land, but it's definitely not as doom and gloom as what we're hearing.
Yeah, and one of the things that I want to just drill down on, because I think it's a really relevant point, is that not everybody is in the same position. And what I mean by that is, yes, you've got some people that may have just been unlucky and bought property at the top of the market, and from a timing perspective, it's just unfortunate. And they may be experiencing, less and less equity, maybe even get into a negative equity position. But what I think is really relevant is you're talking about a range of different borrowers across a range of different circumstances, across a range of different timelines. So property is one of those things that's not easily transactable. So I guess most people, if you weren't thinking about transacting on a property, you're only ever going to sell if your circumstances get to a particular point in time where you say, you know what, actually this is getting too tight. I'm running into some trouble here. I need to sell. And not that I want to discount that, but I think from a property price perspective, we're not going to see these massive crashes unless a lot of people fall into that position. And we're going to hang on as long as we need to from just a love of the asset class perspective. Wages are still at record high levels. Unemployment is at record low levels. People can change jobs, and this ties into the inflation conversation, unfortunately, but people can change jobs and probably get a significant pay increase. There are ways to be able to absorb and manage and navigate through this. Plus, the Reserve Bank, yes, they're more concerned about the economy because if inflation runs, it's very, very difficult to get that back. They are aware of the pain that this is causing for mortgage holders, and as soon as they feel comfortable enough that we're in a good enough position, they'll start tweaking their levers and seeing what they can do. We're not there yet, but I think it's, the strategy for a lot of people is we're going to hold on and we'll just adjust accordingly, which is the intent of this, because the Reserve Bank wants to stop spending so it stops pushing the price growth of things up, which is inflation.
Which is, another interesting point to kind of note, and really relevant in this scenario, is the household savings rate is actually higher than what the household saving rate was pre-COVID. So even though we are seeing interest rates increase, even though we are seeing inflationary pressure on budgets, we still are yet to see the impact, or we are still yet to see a really significant negative impact in terms of household saving rates. So until that starts to diminish, and until we start to see some real pressure on that, I think that's one of the key things that the RBA is looking at with further interest rate rises. I mean, it seems like, yes, there's more uncertainty in the market. Consumer spending is starting to slow down, and there's some, consumer sentiment is not exactly where it was at this time, last year. But the savings rate is still there, and so I think people are really starting to think about where they spend their money, and are really starting to, reduce expenses where they can, because the writing really is on the wall, and we still haven't seen, the full impact of, as you said, what the interest rate rises are going to be. But at this point in time, it seems like households are pretty resilient to what's currently happening.
Yeah, you were talking about the savings rate, but also the amount of money that households have saved throughout COVID as well too.
Yeah.
So the RBA and everybody that's looking at this is aware of that, and they feel like households have got a fairly big and strong buffer and a cushion to be able to help absorb some of these interest rate increases, which is good that they're talking about that, because it means that they're taking these things into consideration. So from a resilience perspective and an ability to be able to hang on and navigate through this, I think households at this point in time anyway are in a pretty good shape to be able to go through it. And hopefully it lasts shorter than it needs to, or shorter than what we're expecting. Once again, we'll just have to wait and see. And I think, the strategies for most people is just tighten the belt a little bit and ride it out.
Yeah, exactly right. Yep. Exactly right. There's also some talk in the market about, a possible recession in the US, what that looks like, the ramifications that's going to have around the world. No doubt there's definitely, some risk associated with that. And we're certainly not in the clear, even though we are looking at, share markets bouncing back to some degree recently, and then sort of tailing off the back end of it. But there is definitely some concerns about the US market. However, some payroll data came out, I think it was last week or a couple of weeks ago, which indicated that employment in the US was actually far better than expected.
Yeah.
So again, that's one of the things that is really holding up global markets at the moment, is really the employment question. So yet to be seen what's going to happen there, but certainly some concerns around it, but also some positive data, which really seems to be the rhetoric around everything. Concerns, but then, light at the end of the tunnel. Whether we're being overly optimistic and whether, economists are being overly optimistic, who knows? But it seems to be what's currently happening at the moment.
It's a snippet of information that you get. So there is some silver lining, and we're just going to concentrate.
Yeah, exactly.
We're going to concentrate on the silver lining. We're not going to concentrate on the cloud. Right. So yeah, we'll see where that ends up going. But yeah, that actually came out of the minutes from, or the comments that the Federal Reserve Chair mentioned, and basically they were saying that getting inflation under control is the primary objective, and it's the US economy going into recession is a secondary consideration. Getting inflation under control is their primary objective, so they'll do whatever they need to, and that obviously stimulated talk around US going into recession out of the back of that. So we're not there yet.
Been pushing interest rates, even more rapidly than what we've been feeling here in Australia. So. I guess, again, that snippet of silver lining. It's like, it's not, we're paying more for our mortgages, but, it's not as bad as what it is in the US. So we're holding on to that.
That's it. Andrew, what about our closer to home, our stock market?
Yeah, so ASX is as at a couple of days ago from when we were recording the podcast, but we're 4.1% down in 2022.
Mm-hmm.
So stock market is down, naturally as expected, given everything that's happening. We are also seeing a little bit of that, volatility come into the stock market now as well. So we're entering into the, almost tail end of reporting season. So a lot of businesses are reporting all of their financials, and we're seeing where everything's landing. What, and how that's going to look is still yet to be known, because we've seen some businesses come through and see some really positive results. But what you tend to see in reporting season is the businesses that have performed well do all of their reporting early, and businesses that haven't quite performed so well start to lag in terms of reporting their financials and impacting their own share price. But we are a little bit down in terms of the share market, but shouldn't surprise most people to hear that.
Oil, global supply chain, energy crisis, war in Ukraine, a lot of things happening.
Yeah. When you're looking at that, there's you could probably have a podcast for an hour across that topic in itself. But the crux of it is oil prices, the energy crisis, the supply chain issues is really having an impact in terms of manufacturing. It's having an impact in terms of the supply of goods, which is impacting inflation. It's impacting the cost of goods, and so the general rhetoric around that is ultimately, until those issues start to sort themselves out and until that starts to really slow down, we're not going to see any meaningful impact in terms of inflation.
Yep. So I think all in all, in summary, basically there's a lot of moving parts to it. Still a lot of uncertainty out there. Increasing interest rates, so the expectation around the cost of servicing debt in particular is going to continue. It'll have an impact on household budgets, no doubt, which should then filter its way through to the economy because people are spending less, get inflation under control, and from there, hopefully things start to normalise and inflation gets back within the target range. But in the short term, still some uncertainty around, I guess, all of those things.
Yeah. And I think that's really the key thing in the market at the moment is, there's snippets of good information. There's, a fair bit of concerns around the market. Where this lands and how it goes is anyone's guess, to be 100% honest. And so that's why in times like this, our advice, what we're talking to clients about is no different to what we talk about when the market's doing well. And that's take a long-term view, invest in good quality assets, make sure that you're not overextending yourself, and you're going to give yourself the best opportunity for success in your finances. That's the ultimate key. Whatever's happening in the market is sometimes just noise, and it's very important to focus on the long term and not just get caught up in all of the noise, and really, for most people, enter into a decision paralysis.
Yeah, Andrew, that's a really good one. And just to elaborate on that a little bit more, I tend to use the phrase that you can't just play the game, and calling it a game is incorrect, but you can't just participate in wealth creation, in all of these things when the sun's shining, and you can't expect that, things are going to be good all of the time. We do go through cycles, and this is different because we haven't experienced something like this before with the level of complexity, but it's the same, it's a cycle. And if you've got a strong financial plan in place and you've got some strategies and, you manage your cash flow well, you remain employed, you borrow at, conservative levels and so on and so forth, you should be in a position to be able to, like all cycles, ride this one out and then take a long-term approach because it helps you focus on turning down the noise and not making silly and irrational decisions when the timing is the wrong time to do those.
Yeah, and capitalise on opportunities.
Yeah. Yep.
I mean, when markets are doing well, everyone's excited, and everyone wants to invest and do things. And when markets are not performing so well, it seems that most people, stop wanting to invest and want to slow things down and whatnot, when in actuality you should be doing it in the opposite sequence. I was going to steal the Warren Buffett quote, but I can't take another Warren Buffett quote away from Billy.
No, feel free. But Andrew, I think we did that one justice. First time on camera as well too. So to our listeners and to our viewers, thank you for your attention. Hopefully you've got a fair bit out of today's episode. I won't call it a podcast anymore.
Yeah,
I guess it's still a podcast. We'll call it a podcast out of today's podcast. And as always, if you need more information, details are in the show notes. And Andrew, thank you.
Billy, thank you for another episode, and thanks to our listeners and viewers.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of AMP Financial Planning.